Good morning, investors. Hopefully you guys are doing well out there. Time to talk about AT&T Incorporated, ticker symbol T. One of the more popular stocks out there, especially if you're going for income and dividends, because AT&T has a 7% yield. That's right, 7% yield on its stock, $2.08 per share for the dividend on AT&T. Sometimes when you see a dividend that high in a low interest rate environment, it should make you concerned a little bit. So we're going to go through the numbers. And I tell you what, AT&T has a lot of stuff going on here when it comes to the numbers. So if you want to learn how to read financial documents, I wouldn't necessarily say start with AT&T, but I tell you what, if you can understand what's going on with AT&T, believe me, you can open up anyone's stock chart and stock financials and probably understand everything that's going on, because AT&T has a lot of stuff going on. So bear with me while we go through the numbers, and then we'll talk about the stock chart, where this one likes to rest, where it wants to go, and we'll talk about, well, maybe we're in buying AT&T, adding to more of shares. So I posted a video yesterday where I talked about AT&T and Verizon, but particularly Verizon, because Verizon reported earnings yesterday, how I use that company as basically a bank account, okay? Now, this stock, AT&T, is down 23% over the last year. Over the last 6 months, though, it's performed a little bit more how we'd expect. It's basically flat. I mean, it's up 0.61%. Now, in an era where we're seeing stocks like GameStop and BlackBerry and these stocks just soar in a day or over a week, maybe something like this doesn't look so attractive, but a portion of your portfolio should be towards those high risk, high reward type bets. But then part of your security could be AT&T. Like I said, I use this more when I invest in AT&T, more for the dividend, more as instead of holding cash, instead of doing treasuries, which are 1 or 2%, I put it in AT&T. And if you're careful where you buy, which is what we'll talk about when we come over the stock chart, well, look, you can collect a nice 6-7% on your money. And if you ever need that money for rent or a car or whatever it might be, even a vacation, well, that money will be there and it will have grown. Now, like I said, AT&T reported their Q4 earnings, and I tell you what, AT&T's got a high dividend. When we look at the numbers, they've got a lot of debt. They've got some servicing that they have to do on that, but they have upside, I believe, probably a little bit higher upside than even Verizon, because they have this HBO Max. They have the Turner Broadcasting, which is TNT, TBS, all these types of networks out there are actually owned by AT&T. Even CNN is owned by AT&T. But what's nice is that that unit is growing. Obviously, with movie theaters shut down, they had to release some movies out into HBO Max, and it helped bolster their subscribers. For 2 years, they reached 41 million subscribers 2 years faster than their initial forecast. So HBO Max is doing pretty nice. We'll get over to the numbers and see how that's, equating to the revenues and the profits. So let's jump over here. We've got our statement of income here. We've got our operating income. What AT&T does is they just give you quarter over quarter over quarter over quarter over quarter. So we get a full view. This is basically this year right here. These are all the quarters this year. We get a 2020 number, and this was actually all of last year. I actually love this. It makes your job easier when you're really trying to kind of back look on a company. They basically give it to you all right here. So here's our most recent quarter. We churned out $45.7 billion in revenue. Tell you what, that was the highest over the previous year. Now, how does it compare to the previous year? We did $47 billion, which was also the highest. So fourth quarter tends to be high for AT&T. But here's the brass tacks. 181 was our revenue, $181 billion in 19, $10 billion lighter, so lower to 171 in 2020. Now, some other stuff going on here. So we've got equipment costs, we've got broadcasting costs, we've got other costs, we've got selling, general, administrative, and then we've got this asset impairment. So I'll show you that here in a second. Basically, all these costs look like they fell in line. Actually, this equipment cost kind of ticked up quite a bit. Maybe they did some investment in the quarter, but that's definitely an anomaly here. We did $7 billion when this is normally a $4 to $5 $5 billion range. Something you might want to dig into, see if that recurs or not. Now, we've got other broadcasting costs that kind of ticked up a little bit. We've got other costs. We've got selling general administrative, which actually ticked up. But you see here, back in 19, we had about the same. Looks like they have some increased cost in that fourth quarter, maybe some marketing costs and things like that. Now, here's the big one, though, is this asset impairment came in at $16 billion. You see here, yes, they have some asset impairment every once in a while, but this was a big write down. So they took a big write down in some kind of asset, could be DirecTV, could be another asset that they have, but this just absolutely obliterated their operating income, because you come down here to operating income or loss. Notice this company over the last 2 years just churned out 7 billion, 5 billion, 7 billion, 3 billion, 6 billion. All of a sudden we lost $10.7 billion in particular, really due to this asset impairment. So that's something that you want to keep in mind. You could add this asset impairment back into this 10, and then you get to about a $5 to $6 billion operating income, which would fall right in line with what you'd expect over the last 2 years or so. So that's something that you can do. Now, the other thing you want to keep in mind is everybody always talks about, oh, AT&T's got all this debt, blah, 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 blah. Okay, here's interest expense. Instead of focusing on how much debt they have, I don't really care about that as much as I care about what it's costing the company. Take a look. $1.89 billion, okay, in interest expense in the quarter. Take a look. That's actually the lowest it's been over 2 years. So they have plenty of debt, okay? But notice we paid $8.4 billion to service that debt in 2019. This year we paid like $500 million less, down to $7.9 billion, okay? So that is in my opinion, that is very key. Not only are they servicing the debt, but they're paying less for that. They're refinancing. The CFO of AT&T deserves a pat on the back. Now, let's take a look at some of the operating revenue of the different segments, because AT&T's got a lot of stuff going on, okay? They've got this Warner Media, but they also have video and broadband and mobility, and they've got communications. They've got a lot of stuff going on. So we've got basically a quarter over quarter view all the way to our most recent quarter. We see here, again, we pull down our operating revenues here of $45 billion, well within line with what we did. Down year over year, but basically in line with what we'd expect with this company. Now, communications came in hot, okay? This is actually the highest read over the last 2 years. Mobility also came in hot, highest read over the last 2 years. Video basically in line, broadband down just slightly, and business wireline down a little bit, and you'd expect that, okay? With the business environment out there, businesses going, people working at home and things like that, you'd actually probably expect that. Now, here's the key, is Warner Media. What I was been watching Warner Media is when they acquired this company, it was $8 to $9 billion in operating revenue. Now, what I noticed is it started to tick off. We see here 7.7, down $1 billion to 6.7, finally ticked up to 7.4 billion, and now we're back to kind of nice growth here, up to 8.5. Now, we're not back into the 9 range, which I think you'd like to see, but Warner Media is starting to pick up some steam. If the Warner Media business of AT&T can really pick up steam, we can grow this over a $10 billion operating income. Well, look, that might be a really good thing. That could create upside in AT&T over and above the dividend that you get, maybe some capital appreciation in the shares. They break it out. Turner, home box office. Here's that HBO read. We got 1.9 billion off of HBO. That's the highest read in 2 years. Okay, that's nice. Or over the last years. Yeah, actually 2 years. Warner Brothers, nice. Okay, considering all the movie theaters are closed. Look how bad this quarter was, 2.4 billion. Ticked it up to 3.2. If you believe movie theaters are coming back, movies coming back, people will go to the movies. That's not a bad business to be in as well. And then you got a little bit of Latin America, not a lot going on there. Now, hang with me. Last slide before we get to the stock chart. The last thing you want to do when we talk about AT&T is come look at cash flows. It tells you a couple different things. Remember that we had that big impairment loss. Okay, here's that big impairment loss. So we're adding that back in on cash flow. So we pull down that net income number, which is ugly, okay? It's a $13 billion loss on the net income side. So on cash flows, you pull down this net income. That comes from your operating statement right here, okay? So we got our net income number right here. We pull that down to cash flows. Notice every year, AT&T for the last year or so been making positive net income, but because of this impairment loss right here, boy, it really affected our net income. So in cash flows, we get to add this back in, along with other things like depreciation, which are non-cash charges and other things that we get to add back in. We get down to a final read on cash flows right here. Net cash provided by operating activities. So this is the cash provided by AT&T operating the business, came in at $10 billion. Okay, is that light over previous quarters? Yeah, we were at 12. Here we are at 8.9, and here we were a year ago at about 12. So it's a little light, but it's not bad. Okay, now the last thing you want to do when you take a look at AT&T's cash flows, come down here to financing activities. So what this is it's quarter over quarter, basically quarter over quarter for a year or so. So you can come down here and repayments of long-term debt. So you can see how those repayments are going. So they're repaying. They've actually accelerated over those quarters. That probably was able to drive down interest costs, because here we see issuance of long-term debt. Notice we issued debt. We issued $16 billion of debt and then about $11 billion of debt. So what AT&T is doing there, they issue $16 billion in debt. They repay 12.9. They issue $10 billion worth of debt. They repay 20. They are refinancing here. This is why their financing costs have gone down. You see in the most recent quarter, they really just repaid debt. They didn't really do that. And then finally, you got dividends paid down here. Those have basically been flat over the last year. Now, let's jump over to the stock chart. Is AT&T worth buying? I see the stock's up fractionally today, about 0.6%. Now, it's stuck here right in the middle of a range where I probably wouldn't be excited about buying AT&T up here at 31, although it could be on its way to a breakout. You got HBO humming, you got movie theaters coming back, maybe DirecTV gets sold, and maybe AT&T breaks out above 31. Wouldn't necessarily be excited about buying the stock down here, but there is a level right under here. It's right at that $26, $27 range. I've had this level marked out for a long time. This is where, you could also set your stop loss. The other thing you could think about with AT&T is, if it breaches a certain area, then something is wrong. It's probably wrong with the broader market, but it could be wrong with AT&T as well. I'd say for me, it's right here at the we'll call that $28, I think $28.50, right in this range. If AT&T breaks that level, well, we've got a big gap here. We've got the March lows down here, all the way down at $26. So I'd expect AT&T, if it breaks the $28.50 range, well, look, it's probably coming all the way back down here. Or I shouldn't say probably. It has a higher probability of coming down here. Now, if you got a fair amount of savings socked up into AT&T or a company like Verizon, well, you probably wouldn't want that to happen. So you would want to cover yourself with maybe some kind of stop loss, which is exactly what I do with my AT&T position. So if it pulls down to $29, I would maybe consider adding a little bit to that. But then again, I'd have my stop loss, maybe 50 cents to $1 below that, just as some added protection. Now, if AT&T comes up here to $31, $32, you could consider selling out of this one. I definitely wouldn't necessarily think about adding to this one unless you had a lot of momentum. They were selling their DirecTV unit. HBO was just humming along. Everything looked good here. So that was AT&T. Take a breath. Congratulate yourself that you finished this, because AT&T is a complicated company. They've got a lot going on. Is this stock going to go up 15, 20% over 2 or 3 months? Honestly, it's not likely. And if you're using this like I do as a kind of a bank account, again, I do have money in a bank account that I keep as safety, but there's always extra money. And so earning 6, 7, 8% on that money is not a bad way to do things, and I use AT&T for that. So that was AT&T. Hopefully you guys enjoyed this one. We'll be back again soon. Good luck with your investments.